Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So what will be our today's topic, Nick?
So I thought we'd discuss today how there are hundreds of ways of investing, and there's no specific right way. So I thought we'd give an example of talking about just one way to value a company, which is the discounted cash flow analysis. And we would talk about how even though that is a very well-defined formula, and there might be different variations of the formula, but they aim to do the same thing. Even if two investors were to use the exact same formula, that they could come up with wildly different valuations for the company. And I thought we'd get into how that is. And do you think that's a great topic for today?
I definitely think so. And I also want to add that when you do the DCF analysis, there are a lot of numbers which can fluctuate, which can affect your final results, because all people are different. And for example, for you, if we speak about the growth or the percentages or the shares outstanding, you can come up with a different number. So how can we distinguish that, and how can we understand which percentages are right?
Exactly. So with the most common DCF formulas, and we're not going to go into the details in this particular episode of how to do a discounted cash flow analysis, but just so you know, there are calculators online. If you type DCF calculator or discounted cash flow calculator, you'll be able to find one and put in all the numbers for your company and come up with a figure. But the main two numbers that are variable, that are your choice as an investor, that's totally up to you. And what makes it so different between investors is the discount rate, which some people call a minimum acceptable rate of return, but really most calculators will label it as the discount rate. And then the other number is the growth rate of the company. And so we'll get into both of those numbers and different ways of deciding what that number is for yourself. But the main thing to think about is that you want to be conservative, because that increases your margin of safety. So we err on the side of conservative for both of these numbers, and then once it's given us a final result to be even more conservative and safe, we do a margin of safety on that, and that's when we buy, and we know it's half of the valuation that we got to through being conservative. Your thoughts?
The main reason and the main thing which you need to consider before understanding which exact number you should put into the growth and all this stuff is just looking on the particular sphere and the particular company. Because if we go through the historical part of the company, and we can see that eventually the average growth rate and the average different percentages of buybacks and all this stuff are the certain amount and the certain percentages, we cannot assume that it will grow faster than the average. So we can definitely put that into the perspective as well. Then we need also to combine these numbers with the competitors and understand, can this number be achievable as well? So these numbers cannot be like our subjective things that we would just optimistically think about the company, or that this number will be okay for us because we are hedged from the inflation as well. In this case, we need to consider every particular company as the special situation and analyze the particular company with its numbers and its particular unique situation.
With the growth rate, what some people do is they will pull up 5 or 6 different types of numbers and choose the lowest one. So looking at the growth rate of the company as per the analysts would be one number. And then some people would say, write down what 75% of that number is to be more conservative. So that's another number. Other people will look at the industry as a whole and see what the growth rate is for that, put that down as another number. or they might look at just the top competitors and see what their growth rate is and put down another number, or look at the last 5 years or 10 years worth of growth rate and try and predict what looks the most average, the most right. Yes, maybe 1 or 2 years was spiked upwards or down, but what's the growth rate of this company, and what do you project for the next 10 years? And then some people will choose a conservative, reasonable, rational number out of those numbers. Maybe some people would even put down like half of the PE rate if it's a really high PE rate, and then compare that to the other numbers and see how reasonable it is. And then once you've got that number, maybe that number is accurate for the next 5 years, but then it's going to go down for the following 5. So you take that into account. So effectively, for your discounted cash flow analysis, you're really using your own judgment, seeing how much time you're going to spend on it as well. Some people spend a lot of time on figuring out growth rate. Some people just use what's in Yahoo as the 5-year growth rate projected, or 75% of that. So there's a lot of ways of coming to it, and we're all unique. So you'll need to try and judge what's a conservative, accurate growth rate for your company, and that's the number you'll use. Anything further on growth rates you'd like to say?
I would like to add that that's why most popular and famous gurus in value investing use the technique like looking at no-brainer companies, because it's really hard to understand the average and the projections and right projections for the particular company over the 5-10 years. But when you understand that this is a great company and this is the great management, and your risk is downsided and protected, and the company has a great moat, you will be definitely receiving the dividends in a huge way, I would say. And personally, I look for the companies at the same way. I look for companies which has a high growth, and I do not do the DCF analysis in Excel or something. I try to use simple numbers and simple calculations in my head. So, for example, if I see that on average the company grows like 15 or 25%, I just use the rule of 72 and calculate the amount of time in which the revenue and net income will be doubled. And I try to think, the question is really simple. Can this company be double its money and double the revenues and income in the next 3-4 years? And you start to analyze the management, you start to analyze the competitive advantages and all this stuff. And this is not the rocket science at all. So you just need to be curious journalist, I would say, learning as much as you can, reading as much as you can, speaking to people, and understand the perspectives of the particular business.
I fully say that with growth rate, one must think to yourself, is it reasonable that this company can grow at this rate for the next 10 years? Is there space in the market to grow? Is it going to be easier or harder? Do they now have competition they didn't have when they had the last 5 years of growth? Is it going to be as easy as it was? Is it going to continue? So do the best you can to come up with a reasonable growth rate, and try and discount that a little bit to be as conservative as possible. And now let's move on to the other number in the discounted cash flow analysis. That's very much your choice. The discounted cash flow analysis has growth and discount as the two main figures. So discount is effectively, some people even call it the minimum acceptable rate of return. So this is the minimum that you want to see over the next 5-10 years in returns per year to make the investment worthwhile. And so the one figure I see very commonly, and a lot of the investors I've spoken to, they use 9%, 8%, or 10%, because that's kind of what the market on average would have given you. And so they use that as a minimum. And then other investors will use 15% as their minimum. They want to see a great return. So the lower your DCF, your discount rate or minimum acceptable return, the lower the intrinsic value will come out as, which means you can buy more companies. And the higher your discount rate is going to make it harder to buy companies, but give you a greater margin of safety. And so you're going to have to choose. And I do recommend going between the 9 and 15%, depending on your own desires. Your thoughts, Eugene, on that?
I just add more margin of safety in this case. So as you said, most investors just use like 8 or 9% because it's the current inflation state in the US and other countries. I add several percentages to that because we do not know what will be the inflation next several years. And as I said previously, when you look at the no-brainer decisions, this is the beauty of this approach. So you can just precisely and calculate on average because you can just project that this company will move in this way. Almost non-analyst know the real value of the company and the real value of net asset and all this stuff. So you can just add I think, the maximum numbers for that. And even though if you see that with the maximum numbers like 14, 15% of the discounted cash flow, the company will still be okay. And this is the great company from all the prospects. What you will have on the upside is like the pleasant bonus, but you are protected from the downside.
We've just covered how to look at two figures in the discounted cash flow analysis that makes you different from every other investor because you'll have a different perception of what rewards you want, what risks you want to take, how certain you are of the growth rate. So at the end of the day, you use the same basic concept of you as an individual investor using your own judgment, your own research across every other kind of aspect of the investing framework that we're going to be discussing. So at every point, you're going to use rational thought, critical thinking to determine what's right for you and what do you see the company. So in future episodes, we'll talk about what questions to ask and we'll talk about checklists and that kind of thing. I think that wraps up what I want to say about this topic. How about you, Eugene? You want to wrap it up?
Yeah, I agree with you that investing is completely different for different people. And there are so many approaches to evaluate the business. There are so many techniques and minutiae for that. And you need to just understand the basic concepts and then just to continuously educate yourself and learn as much as you can about the particular industry, improving your circle of competence. But anyway, this is the end of this episode. Thank you for being with us. We hope you really enjoyed this video. If you have any questions, please write them down in the comments below. We also invite you to Discord group where we discuss different stock ideas, Guru Speaks, books, and others. We also meet there every week as the weekly call, discussing the latest news and stock ideas. It's completely free. So if you have any interest in that, the link will be in the description. And see you next time.